Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the S&P E-mini, the 10-year T-note, the crude oil, and gold markets for Monday, August 22nd. Starting off here with an intraday 4-hourly chart of the September S&P contract, and as we've already discussed in our technical blog from earlier this morning, on an intraday basis you can see the developing potential here for a bullish divergence in momentum that'll be confirmed if the market can show short-term strength above the 1153.25 high from from overnight. It's important to also understand this accompanying this developing bullish divergence prospect is the prospect that the overnight low at 1111.25 completed a nice five-wave Elliott wave sequence down from the 1207 high from last week, exposing a slightly larger degree correction. Also, from a daily close-only basis, you can see the market's recent and even current proximity to the lower recesses of the past couple of weeks' range, where we believe this short to intermediate term strength is exposing or perpetuating what we believe is a slightly larger degree bear market consolidation within the broader peak and reversal threat we've discussed over the past number of weeks. But in this regard, and given some of the recent volatility, even a relatively minor pop could produce some nice nominal gains this week. Per such, we've advised traders to cover their short positions from 1177 at the market earlier this morning, looking now for an intra-range recovery over the next few days. This is going to have a spillover effect into some other markets like T-notes, crude, and gold. And you can see here on an intraday 4-hourly chart of the September T-note contract, the prospect that, or the market's on the verge, we believe, of breaking the 130.07 corrective low from late last week. That will confirm a bearish divergence in short-term momentum and define the 131.20.5 high as the end of at least this latest phase of the bull trend from a 129, the figure low, back from the August 12th period. Now, it's interesting to note this short-term weakness in the context of a developing bearish divergence potential on a daily perspective, but on this larger degree scale, a failure below the 129, the figure low from August 11th, is required to confirm this divergence and expose a correction or reversal lower that would be considered on a larger degree scale. Until or unless the market fails below 129, the figure on a intraday basis from this longer term perspective, on the futures price, and the 2.34% on a 10-year yield basis from August 11th's high close, the broader trend clearly remains down. If we're looking for a larger degree reversal, we have to get confirmation of that with an equally or an appropriately larger degree momentum failure, and in this regard, that's 2.34% on a yield basis and 129 the figure basis the futures contract. And until or unless such weakness is shown, longer-term traders remain advised to maintain a bullish policy, looking to move to a neutral sideline position if the market can break below 129 the figure. Moving to the crude oil market, and as a result of some semblance of intra-range strength in the S&P contract, you can see the crude oil market's recovery overnight after a nice rebound on Friday to an 83.78 high. The market's again pressing that high. We believe it'll take that high out and confirm overnight's 81.18 corrective low as one of developing importance. You can see the importance of last week's 89.19 high, and that's the high this market needs to recover above from a longer-term perspective, shown on a daily log scale here, to expose a larger degree reversal higher. But reversals got to walk before they can run, and a break above Friday's 83.78 high will provide that. And again, most importantly, define the overnight low at 81.18 as a tight, short-term but objective risk parameter to any interim bullish decisions like short covers or cautious bullish punts. It's also important to note that this basing and reversal threat from a shorter-term perspective is also stemming from the area around the 61.8% retrace of the 79.30 to 87.88 rally on a daily log scale close only basis. The 61.8% retrace cuts across at 82.47. The low close thus far from last week as at 82.38. Combined with this short-term strength, we think the market is exposing at least slightly steeper, if intra-range recovery to the 85 to 87 range, and quite possibly a much broader base and reversal above that 89.19 high. These issues considered, traders are advised to move to a neutral to cautiously bullish policy with weakness below 81.18 required to negate that and tilt the directional scales back to the bear side. For shorter term traders with tighter risk profiles, looking here at an hourly chart of the October E-mini contract, establishing cautious bullish positions on a break above the 83.78 high from last Friday will confirm the short to intermediate term trend is up, and again, most importantly, define overnight's low at 81.17.5 as a tight but objective risk parameter to at least interim non-bearish decisions like short covers or cautious bullish punts. And finally, moving to a daily log scale perspective of the gold market that shows the past month and a half's exponential and obvious continuation of the secular bull trend. On this larger degree scale, minimally a failure below the 1725 spot 80 corrective low from August 12th is required to even defer the secular bull trend, let alone threaten it. Such a failure is needed to confirm a bearish divergence in momentum that arguably has been threatening for weeks and for at least $250. So that's why it's important to require proof of weakness below a recent corrective low before concluding a larger degree correction or reversal lower, and we think that that level very specifically and objectively is at 1725 spot 80. From a shorter term perspective, however, looking at a 4-hourly chart, you can see the developing potential for a bearish divergence in momentum that will be confirmed if the market fails below the 1840 spot 10 corrective low from Friday. And for shorter term traders with tighter risk profiles, we advise them to move to a neutral sideline position if the market fails below this now short term but key 1840 level. But for longer term traders, a break below 1725 spot 80 is required to threaten the longer term bull. But you can see there's quite a bit of space between that 1840 short-term momentum failure and 17.25 larger degree risk parameter. And for traders who are of a risk profile who cannot risk this position all the way down to 1725, there's just too much space here between that 1840 and 1725 levels that we believe is totally devoid of any technical levels of merit that provide a more objective risk parameter and stop-out level than that 1840 low. So in sum, a bullish policy remains advised across the board, but for shorter-term traders with tighter risk profiles, we advise moving to a neutral sideline position if the market breaks below 1840. And again, for longer-term traders, weakness below 1725 spot 80 is required to threaten the longer-term bull enough to warrant moving to a neutral sideline position. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.